Good morning. My name is Sammy Azzouz, and I'm the president of Heritage Financial, an independent wealth management firm with offices in Westwood and Woburn. We help people who are serious about their finances build smart, cost-effective portfolios paired with detailed financial planning. And I'm also the author of the personal finance book, Beyond the Basics, Maximizing, Allocating, and Protecting Your Capital. With me today is my friend Greg Rush, an investment banker with Dunn Rush with over 28 years of experience helping businesses find the perfect future partner and transact. And Greg, good to see you today. If you don't mind, introduce yourself a little bit and talk about Dunn Rush.
Thank you, Sammy. It's a pleasure to join you today. Really appreciate you inviting me to be here. So as Sammy mentioned, Dunn Rush Co. is a boutique investment banking firm and broker-dealer. We focus on providing sell-side merger and acquisition advisory services to middle market companies, typically valued between $20 and $250 million. But a lot of what we do is talking to business owners considering all different types of transactions. We have had the ability to do financings, buy side, fairness opinions, valuations. So really, I think our work is with owners of businesses that are trying to understand what their company is worth, how best to maximize that for themselves, their families, and their shareholders, and over whatever that time frame may be.
Great. And today's topic and format is fairly straightforward. An investment banker and a wealth manager getting together to talk about the state of the M&A market, which has been quite active, quite hot in certain segments. We plan on speaking for about 30 minutes with 10 to 15 minutes of Q&A toward the end. You can submit your questions anonymously through the chat feature, and we'll select some to answer. And if we don't get to all of them, we'll definitely follow up and get back to you. And we'll also launch a poll at some point early in the webinar that we'd love you to answer if you can, and we'll talk about the results at the end as well. So with that being said, Greg, it's been a seller's market maybe with M&A for the last 10 years or so. How did COVID impact that? Did it put a damper on it?
Yeah, I think we certainly assumed that there was going to be some kind of an impact from COVID, right? And I think the whole world paused for probably all of Q2 in 2020, where there were a number of deals that were in process. There were people that were thinking about doing a deal, and the number of transactions that actually got completed during Q2 2020 really fell off the map relative to where things have been over more than a decade of sort of up type transaction volumes. But I think after Q2, that really settled in, and as you kind of pointed out, there were some industries and businesses and business models that tended to benefit from the conditions around people working from home and the limitations that that COVID put on people's interaction and travel. Technology companies, software companies, a lot of healthcare oriented companies. There were businesses whose business models really benefited from that. And I think the M&A activity really continued to take off from late Q2 2020 right on through to the end of the year. I do think there was a world of haves and have-nots, right? So, there were a lot of companies that were impacted negatively financially by the COVID pandemic, and many of those companies took a long time to recover and get back to run rates and financial performance that they were seeing prior to the pandemic. Many are still working to do that, right? But I think in terms of volumes and number of transactions, there's so much money out there chasing transactions. I think companies that had favorable business models were in high demand in the end of 2020. Q4 2020 saw a record number of transactions completed on a quarter from a number of the databases that we access and use. I think there was ongoing demand for those companies that did well. And coming into 2021, there was pent-up demand from some of those companies that had not been able to get out before year end and were waiting for their financials to recover. So that all teed things up to be a very busy year this year with a confluence of factors that have made 2021 super active in the M&A space.
And we've chatted before, but you almost explained it to me like there were three different M&A markets, based on COVID. For companies that saw no impact, it was one story. For some that were impacted but were now recovering, it was a little bit of a different story. And some are maybe just off the market because the recovery is still further out.
Yeah, no, we call that like the barbell effect, right? There were companies that were super hot and super active, and the valuations and the pursuit of those companies was very active. There were companies that were troubled, right, and were having very difficult situation and were almost forced to pursue a turnaround or a troubled or a liquidation type scenario. And in the middle, there were a whole bunch of companies that just, were trying to deal with it, weren't impacted so negatively that they had to do something, weren't in position to really, command a valuation or a structure through a process that they would like because of the status of their financials and whether that was revenue or profitability. And those guys were kind of in the middle doing nothing during that time frame. But I think many of them were preparing for what was likely to be an opportunity when the market turned around and when their business performance improved.
And so what are you seeing now as it relates to that?
Yeah, I think there's been a lot of businesses, thinking about and coming to market in 2021. And I think there's a lot of issues. I know we'll talk in a minute about, tax, for example, but in many ways we had a perfect storm of pent-up demand from companies that, maybe weren't able to get into the market in 2020. We had the, threatened increases of taxes that I think a lot of people were concerned about. And I think a lot of business owners reevaluated what their personal timeline was and what their priorities were, and whether, it was time for them to consider exiting the business, either partially or fully, or at least having a plan to do so. So the confluence of all those things created a ton of activity right at the get-go from the beginning of the year. And I think, as you know, and we've talked about a number of times, it's not like you can wake up and decide to sell your business overnight. I mean, this is a long process if you want to do it in an orderly way and get the best price and terms. And it can take 6, 9, or even 12 months to do that. So I think the activity around getting people prepared, teaching them about, what they're going to need to do and how they want to go to market and who they should approach to get the transaction done that they want, because every owner has different priorities and every transaction is different, is something that's really been super busy for us, for people in our business, and lawyers, accountants. I know it's been a very busy year on the wealth planning side as well, right? So I think the activity has been super high. All the people we talk to think that Q4 is going to blow away, even last year's record Q4 because of all the planning elements that go into various tax changes and so forth.
So when you're, and I know you're meeting with you and your team are meeting with a lot of business owners all the time who are either, about to do a transaction or thinking about one down the road. What are you advising them to do? And I have one of your slides up here in terms of, the best levels of preparedness, but what are you talking to them about in terms of, assessing their abilities to either do it now or in the future and to be better prepared?
Yeah, well, I think there's a lot of things that a business owner thinks about in terms of what their priorities are, but there is a very sort of prescribed way that, I think is tried and true in terms of going to market and getting, the best price and terms and structure that suits what you or what your objectives are. And I think it's always about preparation. We always talk to people about things like, what's the right time for you, your company, and the market? And if you can get the nexus of those three things, that's where you're going to have an outstanding outcome. Not that there aren't other outcomes that can work for people, but I think what we've seen this year has been an element of trying to coach people not to let the tax tail wag the dog. Right. I think there were companies that came out of COVID that either weren't in position or their company hadn't recovered fully, so that they really couldn't drive the kind of leverage over a process to get the best price and terms. But I think they were pushing really hard because they were concerned about what the net proceeds were going to be. And I know we'll talk, later about, ultimately, that's the advice we give people, right? It's not about the gross number you might get. It's about the net number that you might have and you might need for your own purposes and for planning and philanthropy and so forth. So, preparation and getting ready has always been, really the key advice that we give people. And, whether that's talking to them about, making sure they've got the right financial controls and reporting, that's a good business management tool, even if you've got no intention of selling the business. I think we also talk to people about, if you do the things that grow the value of your company, the way an outside third party might look at your business, that always helps you. It gives you more flexibility and allows you to do more things on your own terms down the road. And I think that includes, having the right tools, having the handle around forecasts and projections, detailed current year budgets so that you don't get surprised by things that are happening. There are some things with, data rooms. I know, people don't necessarily think about these things, but there are thousands of documents literally that go into the process of doing some of these complex transactions. And I think if you keep them and keep them updated in now what is a quite safe way, and that people on your team throughout your organization can get comfortable posting things as you close months, it just becomes much easier for you to do things when you want, how you want, if you have all those things at your fingertips and you've spent some time preparing and thinking about those things. And then lastly, I think the key to any transaction is internal and external team members that are going to help you get it done. I think it's a big mistake for a lot of owners to think they can do this by themselves. There's a lot of concerns, and valid ones, about confidentiality and not wanting employees and customers and suppliers and things to be concerned about what your strategic priorities might be. But at the end of the day, you need a trusted team. And if you think about it, many of these things are logical, right? I mean, if you put yourself on the other side of the table and think about what you would want to have if you were thinking about acquiring a business or investing in a business, you're going to want to know what the team is that's going to help you move the ball down the field after a transaction. And there are going to be certainly some key people internally that you're going to need to have aligned, and you're going to have sort of comfortable and motivated that, this is a good thing or can be a good thing for them, and they can help you get these things done. And similarly, the sooner you get out there and talk to different people, I mean, it shouldn't cost you any money. Of course, it costs you time, but it shouldn't cost you any money to talk to different advisors, whether it's M&A attorneys that eat, sleep, breathe M&A transactions. It could be advisors that have access to the right type of financial planning tools that a significant change in your liquid net worth might represent. It could be investment bankers. It could be financing sources. But picking the brains of those types of people and understanding what's important to you, who you like, and who you're comfortable working with. The time to do that is long before something comes down the pipe that you have to respond to or want to respond to. You want to have that team ready to go and on deck before you even get there.
Absolutely, and I know that will include a good tax person as well, because
sure.
Obviously what you're going to net from the deal is very dependent on the tax structure, and so it's important to bring that person in the team. And we're going to talk about taxes in a second. Is there anything on these 5 circles that you feel like generalizing some business owners are further behind on than others, or is it just highly dependent and you can't really generalize?
It is highly dependent, but I'll use a comment we see. Like, most people say, oh yeah, we have that, we're in good shape, we know we're ready to go. But I don't think you'd ever talk to anybody that completes a transaction that says, yeah, I wish I had done less preparation, I wish I had less detailed financial reports and so forth. It just doesn't work that way, right? So I mean, most people we work with have never been through a transaction before, and they know people that have, and they think they might have a sense for what it's like, but it's completely different than anything else most of these business owners that in many cases have worked decades to build what they have ever been through. And I do think the financial controls and reporting and a handle on how that's going to be sliced and diced, I think all of these things are about giving the buyers more confidence that you have a handle on what your business is doing, that the things that happen to your business are not going to be a surprise. And I think valuation is a function of buyers being more comfortable to push the envelope and to offer something that they don't have to hold back on, because they think you've got a really good handle on how that all goes. So the combination of these things that you see up on the slide here, I think can really, put a nice tight package together. As I mean, we've talked to people about something we call the gold standard of preparation, which includes a lot of things, right? It could be audited statements and budgets. It could be quality of earnings analysis and those types of things that, have become the norm in doing an M&A transaction. And a lot of this stuff is intuitive, right? I mean, think about whether you would want to have this and what would make you confident to pay the highest price and provide the best terms to a company you might acquire. Sure. You're going to want to know these things.
Yep. So we've talked about taxes a couple times, and I know you and I have chatted that that has been on business owners' minds, maybe some of them at least as much as COVID. Taxes have really been a factor in the M&A market recently.
Yeah, and I think they're always going to be, right? I mean, as you've mentioned it a couple times here. I mean, it's about what you ultimately might take home and be able to put in your pocket and use for the things, for your lifestyle, for your family, for your legacy, for your philanthropic causes and things. And taxes are one of the things that you don't really control, but you do control the timing and how you plan and how you can effectively put things in place that will be efficient, right, in terms of how that transaction is going to happen. I think at the beginning of this year, I think a lot of the activity in Q4 last year was happening in anticipation of, a lot of people think about it as typically tax changes might go into effect as of like a January 1st kind of time frame.
Yep.
And I think people looked at with the election and people, making various proposals and so forth, trying to get something done before 12/31/2020 was a rock solid way to make sure you could take advantage of what by any standard is, I think a pretty favorable tax environment for a business owner in selling a company. And, I think the thought coming into 2021 was that nobody knows what these changes were going to be. You knew it wasn't going to get any better. The proposals in many cases had been fairly draconian in terms of what we were going to see. And, capital gains, for example, the original proposal that had been outlined was to take that to ordinary income rates, which were also going back to the higher levels that were there before. And that was going to double the capital gains tax rate, which is the primary rate that applies to the proceeds people sell their business for. So if you think about that, I mean, that's where, I think a lot of business owners were legitimately concerned that an additional 25% of what otherwise would have been their after-tax net proceeds were literally going to potentially go up in smoke with that one tax. And there were several other taxes that I think you're going to talk to here in a second that would have ultimately significantly eaten into the proceeds of a sale. And, I think that has a lot of ramifications, right? I mean, many of the things that people think about in terms of taxing a business owner, business owners take a lot of risk when they start these companies, and many of them, are mortgaging their homes and certainly providing guarantees for the things that are there so that they can hire people and build a business over many years. And I think, these are the kinds of things that are going to make it hard for people to think about that if they were to go to those levels.
Sure.
So I think a lot of the preparation was done in anticipation of things that could have had a meaningfully negative impact on the net proceeds of a transaction. Now, we still have yet to see how this is going to play out. It hasn't played out year to date. There are some things that can be retroactive about these things. I think, as you know, some of these things on cap gains are currently outlined to potentially be retroactive to September 13th, but you don't know whether those are going to pass. You don't know where it's finally going to go. You don't know what's going to happen Jan 1, but that puts people in a tough spot to try and have to do planning. I do think that, the current proposal is far less challenging on an owner than maybe what the original taking cap gains to ordinary income rates were going to be. It's going from 20 to 25%. I don't want to minimize, what a 5-point increase can have on a business owner's proceeds. But I think that is the kind of thing that will continue to drive the M&A market, beyond what might have been, something that was a challenge to kind of keep the volumes that we've seen going, past these effective dates.
Yeah, I mean, there's a long road from the campaign trail to final legislation. If it ever happens, it looks like something will happen. We don't know. They haven't made as much progress on it as they'd like to, I think. But to your point, it is maybe getting a little bit watered down. The way we advise business owners is, yes, let's be smart about tax planning, but at the end of the day, the tax rules are the tax rules. Let's not overreact or underreact. Let's run some numbers and see whether some of these proposed changes are actually going to impact you, and change your mind about how long you do or don't want to do this in terms of running your business. And we've always found, I think, that not enough business owners do that planning as they're thinking about a deal. And, a good financial plan can not only help you figure out what you need, it can also help you compare deal structures, and as you're negotiating whether this potential deal structure is better for you or not. And so without kind of getting into the predicting game of what's going to happen with taxes, what I put together for this conversation is just to demonstrate for business owners and advisors working with business owners, this is what a financial plan can help you figure out in terms of a business sale, the impact on taxes, or other things. And there's just a short video walking through this that I want to play for us now.
Here's a financial plan we put together for a business owner that received an offer to sell the business. These blue lines represent the value of liquid assets over time based on projected living expenses and reasonable rates of return on investments and inflation. The owner runs out of money in the next 20 years based on just the current savings. We modeled the sale of the business based on the offer that was received. The green lines in the plan show the positive difference with the sale of the business. The plan now looks strong for more than 30 years into the future and beyond life expectancy. there will likely be assets to pass on to future generations. This appears to be true even if we apply higher capital gains taxes at the time of the sale. The owner wasn't sure about selling now, so we modeled a scenario where the business is sold at a later date. Given the likelihood for higher interest rates and a somewhat weaker M&A market in the future, we modeled a slightly lower business valuation for the sale. This scenario showed that while assets would likely last through life expectancy, an unforeseen event could risk the assets running out. In addition, there wouldn't be much to leave to future generations. A key conclusion to our modeling is that the sale price was really the determining factor about the success of this financial plan. In contrast, the potential for higher tax rates wasn't as great a concern. We were able to show that even if the owner sold now and was taxed at a higher capital gains rate, the impact of taxes did not materially hurt the success of the long-run financial plan.
A special thanks to our Director of Financial Planning, Ed Jastrom, who ran these scenarios and recorded the video. And the point of this is that you can look at a lot of different scenarios as you're going through the deal process to see, what's best for you, what you're going to end up with, what things are going to impact you positively and negatively. And it should be kind of a key part of your planning process. So, Greg, if taxes aren't going to be what slows this market down, what are your thoughts? We talked about this as the state of the M&A market. What are your thoughts on the things that you're watching in terms of either positives or headwinds to the M&A market?
Yeah, and Sammy, before I touch on that, just with the model that you just put forward there, I would agree with you that not enough people do that work, right? And I think this is where I think what we do and what your firm does dovetails nicely together. And a lot of times people don't have their advisors collaborate on these things, but there's two key pieces to that, right? It's like knowing your number and knowing what you need, and then knowing what your business is worth and how to go get that, right? So those two pieces of information, critical information for any owner to have, regardless of whether they're going to do a transaction or just want to continue to run the business and have it owned in the family for generations to come. So, thanks for playing that. I think that's an excellent example of how someone can get their mind around how to think about these things. I think to your point, there is a ton of money still out there chasing transactions, right? I mean, the number of private equity funds that are out there pushing transactions, I think the latest number I saw, 77% of transactions that are done involve a financial buyer or private equity firm. So these are people that, their business model is to raise funds, invest them in companies, grow those businesses, and then eventually get a return on those assets through the sale of that business so that they can provide a return to their sort of LPs and investors. And, there's just a lot of money burning holes in pockets of the people that are out there trying to do transactions. So that is something that we expect to continue to have out into the foreseeable future. As you and I have talked, interest rates are probably the one thing, and inflation, that I think is a significant concern. And it does tie back to what we're seeing from the impacts of COVID, what we're seeing in the labor market, the logjam in supply chains. I mean, when was the last time any of us purchased anything, a product or a service that wasn't significantly more expensive? Business owners talk to us all the time about the challenges of hiring people, right? And the cost of labor. I mean, these are not, insignificant increases in costs. And I think the debate has been, are these transitory or are they more permanent? I think clearly we've been the beneficiaries for the last 20 years of extremely low interest rates. And I think that allows businesses to borrow more cheaply, to invest in the capital and the hiring and the people that drive their businesses. It allows buyers to access cheap capital when they can, which allows them to bid more when they're going to be looking at acquisitions and growth through acquisition revenue and profitability. So I think about the things that could slow or temper what has really been quite long bull run in the M&A market. I don't think it's going to stop the transaction activity. I think it could dampen and have an impact on the valuations that I think people see. It could impact the growth of their company, and I think the ability for buyers to cheaply finance the amount of capital necessary to pay those higher prices as we see increased interest rates and inflation.
So money in the system is definitely a boost to the M&A market. Low rates have been as well. Your main takeaway, your main concern is, if rates pick up, inflation picks up, those feed each other. And now all of a sudden, there's just less easy money, less money that's being transacted.
It's direct and indirect impact, right? So I think it's going to impact a company's ability to grow and finance the things that'll allow them to continue to grow their revenue and profitability, which obviously is going to dampen performance. And it also makes it more challenging for buyers to finance things cheaply, neither of which are good for valuations and volume of transactions. I do think the amount of money that's out there and the amount of businesses that have reached a stage where their ownership is looking to transition, that supply and demand, actually both sides of it, is still going to be very high. It just might change the levels of valuation and terms that these transactions are happening on.
Are you seeing any early signs of that or not yet?
Not yet. It's still, I think what's been interesting, when we look back at COVID's impact on transaction valuations and structures, I think there was a bigger impact on the structures than there was on the valuations. I mean, the deals that were getting done, and many of those deals were companies that had fantastic financial performance, even, with and through the impact of COVID. Those valuations continued to increase over what's been a long period of time. We've seen that upticking. We did see changes in structure. I think there was some valid concern from buyers that, hey, we're not going to take the risk on, how long this may go. What if there's a second wave and so forth? So there were things like earnouts, seller financing, contingencies, that typically when we represent a seller, obviously part of what we're out there trying to do is to eliminate or minimize those kind of things by going out to an audience and trying to find potential acquirers that are going to be willing to do things without those. But I think those structures were very common through the back half of 2020 and into the beginning of 21. I think things have started to normalize there a little bit. And I think we're getting back into that mode where structure has become less of an issue. But I have not seen it. I mean, there's still an unbelievable amount of activity in transactions. Valuations are high, and it's still a very good time. And while we talk about this being a risk to what could cool some of these things off, I'm not sure that that's something that's going to impact the foreseeable time frame, months, and certainly next few quarters, because I do think there's an awful lot of demand out there, and I think the supply of quality companies that might be coming to market is also going to be high.
Yeah, and I think this chart kind of reflects that. There it does trend upwards, but not immediately. And so that's great to see. It's always good to get the feedback of people who are on the ground doing deals right now and can tell you what they're seeing. So I'm sure a lot of business owners find this a valuable dialogue. If I could take you behind the scenes into some of those meetings, what are you advising business owners today that you're talking to?
Well, I think when we look at, certainly what people have dealt with in the last 18 to 24 months in their businesses, they've got a lot of things that they're thinking about. And I think, we talk to people about what their ultimate timetables are. We talk to them about, what the growth of the business, has been. Have you recovered? Are you back at pre-pandemic run rates? What are buyers looking for when, what are they valuing? We saw one of the interesting impacts of COVID. One of the databases we have tracks a quality premium, which is, the valuations that businesses that perform above average receive relative to all other transactions. And that quality premium is at an all-time high. I think it's a 33% premium that companies above average are getting over other transactions. And that can equate on average into, 2 or more turns in a multiple of EBITDA. And that valuation premium has typically been, historical average about 15%. So it's more than double with what's gone on now. I think your ability to understand what value you're creating over the next 12 to 18 months is always important, because, I think buyers are going to look at, the best time to do a transaction is when things are good and are growing and are profitable for you, but the buyers can see that it's going to continue to be good and growing and profitable for them. You're never going to stick the landing at the perfect timing, right, as the market kind of turns in another direction or your company's performance does. So try and do the things to evaluate how much value you're creating over the next, X periods of months and quarters. and understand that preparation and the time to actually execute these transactions takes time, and think about those things in the context of your personal timing, the market timing, right? I mean, the market is very strong, and I think a valid concern of owners is, if I wait or if it takes me too long to get to market, what if that market turns and changes? Because it has been good for so long now, and eventually these things do go in cycles, as you know. But
yeah, I mean, so you're not likely to be waiting out a better market.
No, the market is as good as we've seen it. And I've been on every attorney, every transaction accountant or QOE person, every M&A person I know would tell you it's as busy a time. They're seeing interest in quality companies, and valuations is as high and as strong as it's ever been.
And you've talked a little bit about the market cycle and owners maybe needing to assess whether they want to go through a potential future downturn and then sell their business later. And the best advice I could give to a business owner who's owned their business for a long time is just take yourself back to previous market and economic slowdowns. How long did it take your business to recover back to prior peaks? And just think about whether that's the timetable you're willing to go through again if you wait. And a lot of business owners should wait. And depending on your age, how long you want to do this for, market cycles come and go. You don't sell a business every time the market cycle changes, but they should have their own history and experience with weaker economies and how long it took their particular industry or business to get back to prior peaks.
Agreed. And touching on some things that you just mentioned that we've talked about here already, I think, whether it's taxes, whether it's market conditions and so forth, I think it's always important to understand that selling a company or trying to do so at the wrong time for your company and its performance, you will always leave more on the table regardless of market conditions or tax environment than if it's the right time and your company has the right sort of profile and growth. So you want to understand, there's risks, of course, right? Nobody knows exactly what's going to happen with any company over the next 12 to 18 months and so forth. But I think trying to have a sophisticated way in which you evaluate it with the help of your internal and external advisors and team, I think, being as smart as you can about those things puts all the levers in your control. And I think you've heard me say a bunch of times, Sammy, I mean, everybody leaves their business someday, right? It's inevitable. And it can only happen one of two ways: the way you want it, or on your own terms, or on someone else's terms. And I think how prepared you are and how much time you spend evaluating these things and being ready when you do it, when you want to do it, or when you react to something that's an external force that you would have preferred not to react to, at least you're ready to get the best possible transaction done that can be done at that point in time.
Yeah, I mean, to me, that's the biggest takeaway. This is your biggest asset. You've poured your heart and soul, blood, sweat, and tears into it forever. Start to plan for it. Start to plan on how to get liquidity from that asset, or a transition plan that you like. And our team put out a post recently just talking about, there's no such thing as a 5-year plan. Whenever I hear a 5-year plan, I hear, yeah, I know I need to do something, but I'm giving you a number of years that's far enough out that I don't actually have to ever start. And, ditch the 5-year plans maybe and start to think about how to plan for this significant asset.
Absolutely. I've heard people groan when an owner says, "Oh, I started thinking about my transaction 5 years ago," and they're like, "You're kidding me? That's way too." But the reality is, nobody ever wants to do less planning. And every transaction, even the best ones, probably could have been a little bit better and a little bit more efficient if they'd done a little bit more planning. So I think there's a lot that can be done there, but I think just educating yourself on the tools you have available to you, the people who will help you get these things done the right way. You can never start soon enough on those things.
And as we wind down, Greg, and I appreciate that, what is kind of your final thoughts and your ideas for how business owners can take some of what we chatted about today and move forward?
Well, I think first off, I think they need to spend some time, understanding what their own personal priorities are. And, as we've talked about, what's your number, right? What do you need to do the things? And that it's not sort of one threshold. It's, what do you need? What would you like to be able to do? And what would you, dream of doing if you put everything down on a piece of paper that you and your family and your other stakeholders would love to be able to get out of a transaction. And I think a business owner is fortunate in that they might have the tools to be able to do some of those things that other people that don't own a company do. And I think once you've done that, take the time to understand what your business is worth and what it could be worth, right? If you do certain things. And, we have clients that I think would look in the camera and just tell people, it wasn't easy. It wasn't cheap. It can cost you hundreds of thousands of dollars in some cases to surround yourself with the systems and the controls and the people and the advisory that you need. But what you're talking about is a return of many, many, many multiples if you can do those things and craft your own outcome. So that's really the takeaways. These things are not they seem mysterious. I think if you break down the preparation and the process into the step by step what you need to do and the value that each of those things brings to the table. A lot of people see the cost. It's hard to see the benefit, but it's logical. And I think you just have to take the time because it is important. It's in most cases our clients' most significant financial asset for them and their families. And I think it's too important not to take the time to educate yourself.
Great. And yeah, I think that's amazing advice. And, my final takeaway would be, please don't hesitate to reach out to Heritage Financial and Dunn Rush. Our two teams are more than willing to sit down with you and build out a financial plan like the one that you saw a few slides ago. Greg's team is definitely willing to help you understand your business valuation and your business readiness. So if any of these ideas have got you thinking and you want to take the next steps, please don't hesitate to touch base. We're more than happy to take this offline and dive deeper into your particular situation.
For sure. And Sammy, and likewise, I think the information that you and your team can help someone provide in terms of the clarity of what they have, what they want, what they need. I think that information is obviously hugely valuable. The information we can provide about what somebody's business is likely worth is also very valuable. I think in combination, the two things can really provide insight and clarity on some things that most business owners don't necessarily think about all the time, but it can be very important for them to get a handle on those things.
Great. So we did have a couple questions that came in, which we'll go through. I just wanted to share the poll results here for a second before we stop sharing. Are you thinking of selling your business, or do you have a client that is? About 62% of the attendees do. And, to your point, given this market, a lot of it is within the next, 12 months to, within 3 years.
Mm-hmm. One thing I'd say, Sammy, is, selling your business, quote unquote, can be a scary concept for a lot of people, but not all transactions are the same, right? A sale transaction might include selling a portion of the company, selling a chunk of the company and retaining a portion of the new company and taking a second bite at the apple with a partner that you're excited about, that's aligned and interested in growing the business and helping you do those things. So that's one point is, a lot of people fear the concept of a sale. A lot of business owners we know, their life has been wrapped up in the company, right? And they view themselves and their company as one and the same. But there are some things that you can do that would be categorized as a sale that will help you take some chips off the table, maybe diversify your risk, not have all your eggs in one basket, and give you some opportunity and some deeper pockets to help you finance either acquisitions of your own, investment and growth in new facilities and adding people. It can mean many, many things, and it shouldn't be an intimidating thing to evaluate what might make sense for you.
So Greg, the first question in here is for you. Greg, your gold standard mentions a quality of earnings analysis. Please describe that, and how do you construct that as a management tool?
So a quality of earnings analysis is something that's emerged in the last, 10, maybe 15 years as a critical tool in an M&A transaction. It began as something that buyers were using as a way to come in and evaluate a seller's financials, right on down to the line items in your general ledger and trial balance. And I think what it is a defined term. So it's a report that's done by an accounting firm. It's one that typically has a segmented sort of transaction services group that might be entirely separate from the audit and controls group of those firms. An audit, right? I think people are familiar with what an audit is. It's sort of backward looking, factual, GAAP, generally accepted accounting principles. And I think that's a belt and suspenders document that all banks and financing sources have historically always used. About 5-6 years ago, as sellers started to see buyers using this quality of earnings or QOE report as a way to come in and bulletproof and kind of check and maybe recheck the numbers, potentially even change the terms on which a proposed deal was going to happen, sellers get smart too, right? I mean, they say, well, if that's going to be used against me potentially, and buyers may know more about the guts of my business and my financials than I do, I'm going to do that. And I'm going to spend the money to make sure that A, I might be able to address and fix anything that could be found there. And B, now I've set the sandbox in which this whole discussion around financials, and I've got an advisor that's going to take the lead role in working with the buyer's advisor on those things. And a quality of earnings, the way it's different than an audit is it can be forward looking, right? So I think people have always used historical financials as the baseline on which what a buyer is expecting to be able to generate in the future. But I think a quality of earnings will go in and it will take a look at things that are add backs or non-recurring expenses or private company expenses that a buyer isn't going to incur. They'll give you credit for those types of things on a cash flow basis. They will take new customers potentially and extrapolate that impact going forward. Likewise, they're going to take a lost customer, right, and remove that because it's not something they're going to benefit from going forward. So it's a much more forward-looking document and sort of a pro forma analysis that is performed by an accounting firm that still is going to stick to those types of accounting principles. But it's really become the defining document around which, I mean, valuation ultimately is about cash flow, right? I mean, you hear people talk about revenue multiples and this, that, but ultimately it's not always your cash flow. It could be the cash flow that a buyer expects to generate. But that's what it is. It's somebody that's going to come in and bulletproof what your cash flow is on a recurring basis and what it's expected to be for a buyer going forward.
When do you do it?
So, typically this is the kind of thing you're going to do right at the point where you start a process. Now, that said, you can prepare and you can have the kind of things identified, in your general ledger or your financial systems that are going to be the type of line items that, your accounting advisor or a buyer's accounting advisor would tag and identify as part of a quality of earnings. And so that you can keep a running thought on what your adjusted EBITDA. I mean, that's the basis on which most transactions, right, that we work on are going to be evaluated. And I think that you typically would start this as you would be kicking off a process. It can take you, 30 to 45 days probably to get that start to finish. But a lot of times you're doing a preliminary report that isn't, it might be issued in draft format that you're going to bring down or update as you get further down the process. Every company that we work with, we would help put together some numbers that would show what your adjusted EBITDA is. This becomes a third-party resource that verifies what that might be. And it gives buyers more confidence that these are the numbers we're going to be able to get financed, gives them more confidence that they can push higher and stretch a little further on valuation.
Another question came up as it relates to something you mentioned. How often do you see people selling a portion of their business versus an entire transaction, and what drives you to do that?
Yeah, so there's sort of two ways that typically happens, right? You sell a controlling stake where you're going to, sell a portion of your business that's more than 50% so that the buyer is ultimately going to control that. And then there's a minority stake where you're selling less than 50%. I think the activity on those two fronts is very different, right? Lots of transactions with private equity firms ultimately are, you're retaining some stake in the new company. So it could be categorized as selling a portion, but selling control. I think the vast majority of transactions you read about and see are control sales. Minority stakes, while it might seem interesting, I think, there are some drawbacks to that. And I think, not always the kind of drawbacks a seller wants to have. You're going to have a pretty heavy discount if you're selling a non-control stake in a private company. I think, it's illiquid. They don't control the timing on when things can happen. And I think you're going to see, traditionally, and it's different in every situation, but it might be a 20% discount for lack of marketability, a 20% discount for lack of control. And when somebody starts to think about selling a meaningful portion of their company, but not a controlling stake at a 40% discount to what a change of control might be, that it just isn't something that people are interested in doing. There are other things they can do to get partial liquidity. There are dividend recaps you could do if you don't have a lot of debt on your business today and you're generating cash flow. But I think that's why when someone starts thinking about doing a transaction, it's just as much work. You're bringing in a partner, aligning yourself with a private equity firm who, maybe is, if you think about their business, I mean, you got to pick the right group that has the right philosophy and the right personalities and people for you. But, if you're a widget manufacturer, you know everything there is about building a widget and selling it and making profits doing that. Private equity firms, I mean, this is what they're good at, right? I mean, they help buy, grow, and sell companies at higher values. So latching your wagon to the person you're comfortable with, whose business model is to do that, and their track record and success is doing that. There are lots of people that do that type of transaction where they're rolling 20, 30, 40% of their sale, if you will, into an ownership stake of the new company for a second bite at the apple. I don't have an exact percentage on that. I mean, in fact, there's been so much cash available in the market in the last 10, 15 years. Almost all the transactions we've done, while they evaluate proposals that might allow for a significant rollover or partial sale, the cash proceeds that have been offered by buyers have been overwhelmingly attractive, I think, to a lot of sellers. And I think it doesn't mean if you don't want to have, you can go structure a deal and you can go out to buyers that are going to require a significant rollover and give you that second bite at the apple in 2, 3, 4, 5 years when they go to sell that business. But it's one of those things that you can craft the type of transaction and go to the audience that's going to do the deal that you think is most interesting to you.
Great. Well, thank you, Greg. I think that was the second question. And the last one for us today is just a general sense of how long it takes to complete a deal.
Yeah, I think
I'm sure that's a very loaded question.
I think it depends, right? Because companies get bought and sold different ways all the time, right? And I think in general, if you want to run a process designed to go to a reasonable audience of buyers that are likely to give you the best price and terms on a transaction, you should expect a 9-month process. I would generally say 6 to 12. I think a lot of that depends on how it's preparation up front. Once you get out and you go to market and you start approaching people, I think there's a more predictable timetable on which, you provide the materials after signing non-disclosure agreements, you get bids on a certain date, you select some people to meet with, you get final offers, you pick one, and then it takes 60 days to close. I mean, there's a relatively predictable process once that happens. But I think the game largely is making sure your preparation on the front end is so solid and you've anticipated all the materials and information and questions that might be asked, so that once you pull back the curtain and get out in front of people, you're moving as rapidly as you can to closing. Because I think it's never the things you expect that delay the timetable or sidetrack your deal. It's sure. Being prepared to move fast so you can avoid the things that might happen that you don't expect or that come out of the blue. And so, I think it's we tell people to plan for it being a 9 to 12 month process. And if it can get done sooner, that's great. But, I think that's typically what it is. If you go on a negotiated basis with one party, you might be able to get something done sooner. But I think in those cases, you're not going to know whether you've got the best price and terms. In most cases, in almost all cases, if you had the ability to run an auction and have an audience of suitors, you're going to leave price and terms on the table when you do that. But, that's why knowing your number is important too, right? I mean, if you know your number and know what it's going to take to make you happy and give you everything you need to know, the type of transaction and the timetable you pursue can be impacted by that.
Absolutely. Great. No, thank you very much, Greg, for joining me today and taking the time out both today and to prepare for this session. I know I speak for all the attendees that your insight is invaluable. And thank you all for joining us as well. And as we conclude this, I will say there will be a video recording of this that we'll be sharing with all of you. And also, if you're looking for more information, I would push you to the Dunn Rush website, where a lot of the resources and information that Greg was talking about are shared there. And Heritage Financial also has a business owner resources page. And please also don't hesitate to reach out to either firm to continue the dialogue. So thank you very much, Greg, and thank you all for attending.
Thank you, Sammy. I really appreciate you including me.
Thanks.
Have a good day.
Bye-bye.